Welcome to CNBC Pro Talks. I'm Silvia Amaro, and today we are going to speak to Stephen Yu, the CIO of Whale Capital. Now, enthusiasm for artificial intelligence has propelled stock markets to all-time highs this year. While some are cautious about what comes next, Stephen and his Blue Whale Growth Fund remain invested in many of the stocks behind the rally, including Nvidia. Stephen manages $1.4 billion in assets with a fund that typically has a high conviction portfolio of up to 35 stocks. Stephen Yu, CIO of Blue Whale Capital, is joining us today. Stephen, great to have the chance to speak with you at this time when we're assessing the outlook for U.S. equities. In particular, what's going to happen for the big tech amid the narrative around AI. Before we dive into stock-specific conversations, I'd just like to get an initial thought from you in terms of the outlook for AI-related stocks, because I know that in recent times you have cut some of the exposure to the Magnificent Seven. Explain the rationale behind that and whether perhaps you're changing a little bit the approach here going into the new year.
So on a very high level, within the AI domain, that we are very much pro-AI infrastructure versus AI applications. So any company that are on the receiving end of the AI spending, such as Nvidia, Broadcom, or Vertiv, we really much like them continuously going into 2025. But companies who are ended up spending a lot of money into AI infrastructure to develop the applications like Copilots, Google Gemini, or some others, like we are increasingly negative in terms of the return on investment from these companies. So within the positioning of the fund in itself, that we have been shifting away from AI applications company and very much into AI infrastructure. Has been our position this year.
So let's talk stocks specifically. When you think about Nvidia, this seems to be the one where you're still quite bullish on, and yet it seems that you have also cut a little bit the exposure there. I would like to understand why did you do so, and when you saw the recent moves earlier this week on Nvidia, was that a moment perhaps to rethink whether this could actually be a buy opportunity?
Yeah, so in terms of the AI infrastructure, obviously as a bottom-up stock pickers who can only invest into so many stocks, that we are very selective in terms of where we allocate our capital. So we always want to optimize the asset allocation within even the AI domain. And we have had both Nvidia and Broadcom in the fund for this year. And so what have happened over the last week or so was that after Broadcom reported a very strong set of results, including giving guidance about the AI revenue they're going to generate from some of the big tech spenders, that we have decided to revisit our investment thesis on Nvidia. And so obviously we have had a very large position, which has been just short of 10%, when Nvidia's market cap was at around $1 trillion until recently, until Friday last week. And we have made quite a lot of profits on the back of that. We still like Nvidia as a company. We still have an overweight position in Nvidia, but it's a lot smaller now compared to the 12-month period going into last Friday. I think the issue with Nvidia now is obviously it's a law of large numbers. We don't see much competition with the exception of Broadcom, which is basically big tech companies want to do some of these things in-house, so it's more economical for them. We do recognize that at some point enterprises are going to come in to spend money, like the HSBC, the P&G, the Nestle, JP Morgan. They're not going to have their in-house GPU, so they still need to go with Nvidia, which is the market leader in AI GPU. But of course, then you look at the valuation, you look at kind of maybe that could be a shift of sentiment. It's never going to be a straight line, is it? A lot of people have been trying to take a negative view on Nvidia, which they have been wrong. I think for us now, we got some tangible numbers from Broadcom, and what we do know as a fact is Nvidia is going to make less money from AI just because Broadcom is taking a decent share on the back of that in the next 2 years. So that is the view that we're trying to assess today.
What I would like to understand as well is when you think about 2025, and now it seems that the competition between Nvidia and Broadcom is just intensifying. I was wondering whether you're concerned about this growing competition for the outlook for Nvidia, on top of the fact that geopolitics could also have a role here in the outlook for Nvidia. How are you thinking about the risks for Nvidia itself in the new year?
Geopolitics is a difficult one because obviously there's a few things going on. One is about technology kind of restriction from the US selling into the likes of China. And secondly, you have the risk of Taiwan, whether Taiwan would remain autonomous. And that's a view that we think is going to be fine for now. But I think everyone would need to assess the situation yourself, because it's one of those things. It's very difficult to take. It's not a probability weighted event that things could happen just like anything else. And I think on a very high level that when you look at the revenue mix of Nvidia, let's say selling their chips to China or some other stuff, I think at the moment it's fine because they are already been restricted to sell the highest end of GPU into China. So whatever they're selling to China now is a bit more lower tier. So ultimately then the question is like, do you want to restrict the entire kind of technology to China, or is that going to be a bit like anything else that you just want to make sure that your technological gap between the US and China would remain quite large? And of course you can never stop China, isn't it? But maybe slowing them down, it would be helpful. So I think there's a lot of measures that are already been done, but we're not ruling out that could be further things that could happen. But of course, if you're thinking about AI in particular, then it's not so much dependent on China, isn't it? It's about the big tech spenders in the Western world, and there's a lot of very interesting development going on there.
Stephen, I have to tell you that the questions we obtain from our subscribers, they were very focused on Nvidia. So I want to share a couple of them with you just to make sure that we also reply to our subscribers here. I would like to share one question that we obtained from David Tilston here in the United Kingdom. He asks, will Nvidia be able to keep up its earnings growth through 2025 and onwards? And of course, you already addressed this a little bit. And which other companies do you see as big beneficiaries from AI in the new year?
Yeah, so if you look at the valuation of Nvidia today, looking at 12-month PE ratio, which most people would look at, and Nvidia is trading at just over 30 times earnings in the next 12 months, which is exactly in a similar camp as Apple, Walmart, MasterCard, Amazon, Microsoft. So in terms of the valuation that Nvidia is trading at today, it's not excessive, right? Like there's a bit of quality, there's quite a lot of growth behind the scene. And even if you think about Apple is trading at a similar valuation with a very low growth profile, of course the ecosystem is very strong, then what we would say is Nvidia's valuation is not excessive. And if you think about what 30 times earnings means, is like the growth expectation going into the next 2 years is not going to be 50 to 100% that Nvidia has delivered before over the last 2 years or so. And then if you look at the expected growth in revenue terms, it's only in the range of early in kind of mid-30s in the next 2 years CAGR, which we would think like that's very achievable from an Nvidia perspective. Because if you think about some of the Blackwell pipeline that they're going to launch, the product pipeline, that they already have got a pre-order, right? Like you're not going to just Nvidia launch some new product and then the big tech will think, oh, maybe we should buy it, maybe we shouldn't buy it. It's like there's already commitments to do that in the next probably 12 to 18 months or so. Of course, the very difficult question to answer, which everyone would need to do themselves, including us at Blue Whale here, is what happened after 2 years. Like, does the AI demand just suddenly disappear, or does it stabilize at a reasonable level? So to us, at some point, the growth is going to slow down, but it's already expected in the share price terms, in valuation context. And at the same time, if you're saying, and then in a few years' time, that will be the replacement cycle, just a bit like your smartphone, that you're not going to buy a new iPhone every year, but you will buy a new iPhone maybe every 3 to 4 years. So that would be very similar dynamics within the GPU space.
Interesting. Let's stay in this space. I want to share a question from Neil Cannon as well in the US. The question here is there actually a reason to own other names in the chip sector besides Nvidia? How can you basically diversify? Because we're told to diversify, but there's so much bullishness in the chip space as well. How would you respond to that? So
we do still like Nvidia, as I mentioned, that we have a smaller overweight position now compared to before. It's just a matter of the potential outperformance from here, right? Like we're not expecting Nvidia to double from here in the next 2 years. It's very difficult from a law of large number perspective. But within the AI domain, the AI infrastructure domain, that we continue to like Broadcom. Broadcom is not Nvidia, but we would expect Broadcom to be the next Nvidia in terms of outperformance potential, just because they are working very closely with the big tech companies, and you can kind of understand or appreciate why the big tech companies want to move away from Nvidia. Firstly, Nvidia's GPU is very powerful, at the same time very expensive. But then what you don't want to do from a Microsoft perspective is you become overly dependent with one single supplier, which is Nvidia. And then ultimately then you have a question mark about the quality of the business when you're very dependent on one single company. So they're moving away, trying to do their own in-house GPU. So there's a natural transition now going into the next couple of years. There's some of these big tech companies going to reallocate some of the spend that used to go to Nvidia back to their in-house GPU, which is basically what Broadcom does. And then secondly, we do have another company called Vertiv that we really like, and what Vertiv does is liquid cooling systems for data center. So as we all know, that GPU AI compute is a lot more energy intensive, and of course, I mean, you probably want to save energies to make it more efficient, less costly to run AI inference and all that stuff. So you would need to have the liquid cooling kind of system or solution to make your data center to be economical. So Vertiv would be one of those names that is not directly exposed to AI, but it would benefit a lot in the background.
But is there where the biggest opportunity actually is when you think about AI? Not so much anymore the big names like Nvidia and perhaps even Broadcom, but more so second-hand businesses in terms of how to deal with AI?
It's a very big question. So obviously we have started to take a very negative view on AI application companies such as Microsoft, Alphabet, and some others, and even Meta, that we have done very well on the back of Meta over the last 12 months or so, but recently we have reduced our exposure to Meta too, just because that maybe this journey of increasing spend in AI there's no end to it, meaning that maybe before we actually see any return on investment from a shareholder perspective, that could be a long waiting time, which investors typically don't like. So we probably want to reduce our risk in terms of that narrative. But if you think about some of the companies that are going to embrace AI, let's say, you're a big company, Fortune 500 companies, you're going to embrace AI. I think there's always an element of the first mover advantage, right? If you're going to do this now before any of your competitors, let's say within the banking domain, if HSBC or JP Morgan is going to do it, all the other banks are basically a bit slow, and you might be able to offer some cost savings, efficiency, or maybe new solution for customers, and people will like that. But over time, to me, at Blue Whale here, is that a lot of this efficiency or kind of new capabilities is a commodity. It's a bit like your e-commerce capability. If you now look across the world, like it's not just Amazon who just pioneered this journey. Any high street retailer would have a e-commerce or like a shopping button or checkout buttons online. But it doesn't mean they're going to make more money on the back of that, because in the opposite manner, that it's more expensive to have customers to check out from your website, to ship certain items to them, and then they might be returning a few other items, in contrast to, you're just going to have a high street shop and then everyone's going to come in to do the shopping. So in terms of the sales per square foot, it's a lot higher than when you are just letting everyone to buy stuff from your website. So from our perspective, is there's going to be some efficiency, cost savings initially, but over time is a zero-sum game. Zero-sum games means everyone is going to have that. So then there's the debates about, okay, if you're first mover quick enough, maybe you can then win more market share, assuming that other people are not going to take advantage of this opportunity. But of course, I think when you follow some of the CEOs' recent results or conferences, I think AI as kind of investment is one of the most commonly used phrase. So what it means is everyone is thinking about this or doing something in this area.
And you know how often we refer to Nvidia as being the AI darling or the AI star? I'm just wondering whether Broadcom is actually going to be leading the narrative here. Do you think that Broadcom is actually going to surpass Nvidia?
It's not going to surpass Nvidia in revenue terms, just because Broadcom's business, 50% of that is in software. The other 50%, including the latest number they have announced, is going to be in AI. So Broadcom is not a pure play in AI like Nvidia, and Nvidia is 100% is pure AI GPU. Broadcom is not. But I think from our perspective, when we say it's the new Nvidia going into, let's say, 2025, it's about the return potential, right? So Broadcom has just gone up by over 25% or 30% actually in the last 2 days from Friday to Monday. And at the same time, Broadcom is a smaller company. It's only a $1 trillion company. So for a $1 trillion company to go up 50%, become $1.5 trillion, which is reasonable. But for Nvidia to do that, they would need to add another $1.5 trillion, which is very big numbers, right? And of course, and when you go back to think about the logistics in terms of capacity constraint, whether TSMC can deliver the GPU, whether they have enough customers to continue to spend money, that is a question mark. So it's a lot more difficult for Nvidia to grow exponentially for here. But for Broadcom, because it's smaller, at the same time that the big tech are trying to make the shift away from Nvidia, so you have a natural tailwind.
Got it.
Just because whatever uncertainty you'll be thinking about. So let's say, imagine on a very high level, if you think about, oh, we are not sure what's going on in the next 2 years, after 2 years for Nvidia's number, I think Broadcom would be a better place to be because they see the natural transition away from Nvidia GPU from a big tech perspective.
How about AMD in this context?
So we have done some work on both AMD and Intel. Previously, I think we got asked a lot about AMD at the beginning of this year, suggesting whether AMD is going to be a competitor to Nvidia. And our answer has been consistently no, that AMD would never become a competitor to Nvidia. So on two things. One is, if you think about Nvidia GPU, it's not really the same as a CPU, right? If you have the Intel CPU versus AMD CPU, it doesn't really matter. You can just change your computer, your PC, and everything would work on the same kind of PC. But for any AI applications that have ever been developed and still being developing today, they are being programmed on Nvidia, specifically the CUDA platform, which is the Nvidia proprietary platform or the software domain that's powering that. It's a bit like your iPhone using iOS, you have Android using a different system, the Google phone or the Samsung phone. So they're very different. So in order for AMD to become a competitor, they would need to convince a lot of software developers to start with. Can you come to my ecosystem to program all the AI application that Adobe has done, Microsoft has done, to use AMD chip? And it's very expensive or costly exercise. At the moment, no one have the time to think about this. I just want to roll out my AI application as soon as possible. So from that perspective, it's very difficult. When I say difficult, means that it would take some time before it become a very strong competitor, which might or might not happen, right? Like, for example, like Intel probably is not in the mix at all, even though they want to join the race. And then the other interesting number, which if people are really interested into the AI space, that you should refer to a slide that has been published by AMD, that they basically came out with this slide to showcase that there's going to be like a few $100 billion of opportunity in AI. But then the question that we were asking when we saw that slide this year was that how much share AMD is going to get. I think the answer is quite minimal.
I want to go back to the point of the other AI-related stories here, because I noticed among your top 10 holdings, you have Applied Materials. Explain to us the rationale behind that and why you're owning so much of Applied Materials.
So in terms of the semiconductor space, that we have a very large exposure to semiconductor equipment companies, so including both Applied Materials and Lam Research. So we consistently have got these two companies in the fund. It's not so much to do with AI. Obviously, AI would help the chip because ultimately you need the semiconductor equipment companies to deliver the AI GPU and all the stuff, right? So it's related, but it's not so much about that. From our perspective, it's all about silicon sovereignty. So this is a bit interesting in a way that if you think about what's going on in Asia Pacific, that there's a risk that Taiwan would no longer be autonomous at some point, okay, whether it's tomorrow or maybe in a few years' time. That's a question that the audience would need to answer themselves. But from our perspective, it's just a matter of time that it would happen. So but in today's context, that if you look at what Taiwan means to the rest of the world, it's all about TSMC. It's all about the semiconductor production coming out from China, which we also own TSMC. And so TSMC biggest customers are Apple, Nvidia, AMD, because they purely, they only use TSMC to do this. And of course, the Western government has recognized that, right? It's a bit similar to your 1990s about the US going into Iraq, and because they haven't got, they're not self-sufficient in oil, but it's exactly the same situation today, that we are not self-sufficient in semiconductor production capability. So the Western government, the US, have started that journey, initiating CHIPS Act in 2022, followed by EU. And at the moment, when you look at the numbers across the world in terms of new foundries going to be built, it's going to be about $400 billion. So $400 billion has been committed to build new foundries in the rest of the world, in the US, many states in the US, in Europe, and in Asia, outside of Taiwan. So what it means is if you are selling the mission critical equipments, let's say like Lam Research or Applied Materials, then you end up selling more of your equipments to these new foundries, because we're trying to de-risk away from Taiwan or Asia from that perspective. So it's more from on that note that we like both companies. But this year, if you look at the share prices this year, they have not done as well as some other AI names.
I would like to go back to Magnificent Seven, because I saw one of your comments in recent times suggesting that perhaps you could actually sell all of your position in Microsoft. So I'm curious to know whether you've sold all of it. What are you thinking when it comes to Microsoft?
So Microsoft has been a very interesting company to us, very close to heart actually, because since we started 7 years ago, we have had Microsoft in the fund consistently in our top 10 until August this year for 7 years. Very consistent, so which is unusual. We don't have any other company like that. But when we first started investing into Microsoft, Microsoft market cap at the time was at about $500 billion. Sounds like a quite small number, but that was 7 years ago. Of course, today that number is $3 trillion. And what we used to like about Microsoft is Microsoft was transitioning into the cloud subscription model, which is a lot more high quality. And now everyone's being locked into the ecosystem. They can increase prices and all that stuff. And of course, previously, Microsoft business model has always been quite capital light because it's a software business. But what have changed this year, which started our journey to reduce our position in Microsoft, and Microsoft dropped out from our top 10. If you put some numbers in context, at the beginning of the year, we had just about 8% in Microsoft, and currently we have about 2% Microsoft. So we are reassessing whether we want to keep the position or we want to exit completely. It's inconclusive yet. The rationale behind that reduction was that Microsoft, of course, just like any other Mac 6 company, have been spending a lot of money investing into AI infrastructure.
Yeah.
And that's a question mark about the return on investment, which even though we want to be very optimistic that AI is going to change the world, that is still our belief that generative AI is going to change our day-to-day in time. We need to debate about the timing. We need to debate on return on investment. Are we willing to pay for this? Is there going to be a lag between we are willing to pay for something, or you need to make something very cheap and economical for us to get used to? So there's a lot of question mark on that. But then the other thing which is very interesting, if you look at the free cash flow projection for Microsoft and Nvidia in the next 12 months, Nvidia today is generating more free cash flow than Microsoft. And free cash flow, as a definition, is after capital expenditure. So what it means is quite a lot of Microsoft free cash flow has gone into Nvidia's revenue. And of course, Nvidia remain a very capital light business model because they outsource everything to TSMC to produce, and they don't need to invest into AI infrastructure because they are the AI infrastructure company. So from that perspective, that when we look at the valuation, when you look at the return on invested capital profile of Microsoft going forward, right, it's always about forward looking, that we would expect Microsoft quality of this business model is going to come down rather than expanding, just because they didn't used to pay Nvidia when they do the cloud OneDrive. It's just a bit of data storage, it's in a bit of memory. But going forward, in order for them to remain competitive, they will need to spend a lot of money in AI, either with Nvidia or Broadcom.
So as you're assessing your position on Microsoft going forward, what will it take? What is the event or message from the company that you're going to be looking for in order to decide whether you're selling the other 2% that you have?
So I think this is a very good one. So we are monitoring the take-up rates or the kind of the use cases of co-pilots quite closely. Right, so we are a small company. We do subscribe to co-pilots. At the moment, we probably haven't seen enough, but we do appreciate that the improvement is continuous, but we're paying for that at the same time. So if you ask me to look back over the last 6 months, should we have paid for it? I would probably say no, but we're paying for it just because we want to understand the product from an investment perspective, right? Like we need to be the user to start with that journey. So for us, when we do financial modeling, we do put the numbers in to expect how many people are going to, how many companies or how many seats they can sell the co-pilots, what sort of price they may be paying. I think at the moment, there's a lot of Fortune 500 companies are using it. We don't know the prices they're paying because I'm sure there's going to be some special discount or deal just to get people into the ecosystem. So if we do see some signs of co-pilots not actually working out in terms of the take-up rate, in terms of user cases, then we might need to reconsider our position because that ultimately, as far as Microsoft is concerned, Copilot is a big deal for them. But at the moment, it's not a very simple story because when we talk about Copilot from Microsoft, you have the search function, Copilot, you have the Excel Copilot, you have the Outlook Copilot. There's a lot of Copilots. Within Microsoft, it's not one single Copilot here. So I think that they need to probably get things in sync. And because at the moment, if you use the word Copilot, it doesn't talk to the Copilot in Teams and doesn't talk to the PowerPoint Copilot. So at the moment, it's still not really coming together. I mean, we would expect they are working really hard on it, but I think the take-up rate and the use cases of Copilot into 2025 would be a very important metric to look at because then you can then marry that back. Okay, Microsoft has spent, I don't know, over $50 billion in AI infrastructure. Okay, so what are you going to charge users for that? And at the same time, if you think about it, it's very important from a numbers perspective that all the money they've ever spent in AI today from the Mac 6 is through capital expenditure, right? What it means is at some point, which is going into next year, they will need to depreciate. Okay, of course, they can play around with the accounting trick. Okay, maybe you depreciate over the course of next 5 years rather than 3 years. You can prolong that. But that depreciation charge is going to hit the profit if they're not going to come up with the equivalent revenue to offset that. So it's going to be increasingly more important as far as the AI applications are concerned.
I want to take a different look at the tech space into 2025. One of the conversations we had in one of our shows this week was around quantum. And I'm keen to understand your thoughts on Alphabet in particular, given the announcement from Google around Willow. I was just wondering if this is an area you're looking at, whether do you think this is a market that actually offers opportunities now that perhaps there's a tad saturation with the AI story? Is this perhaps the next big market narrative for tech names?
So I have to admit that we are not expert in quantum computing. I mean, we have done some research or reading on a very high level, but from our perspective, is quantum computing, if it does work out, okay, I think today is too early. Whatever that announcement was, I think that that would be a huge gap, but until the time that we'll see some real implications. But if it does work out, this is going to be the biggest risk to Nvidia's GPU business, right? This is the thing that is going to change the way how computing are done, maybe how the new AI models are going to be built. But at the moment, it's too early to see that. And of course, if you just try to invest into some company that are exposed to quantum computing, they're probably loss-making because there's not enough applications on the back of quantum computing. But it's something that investors should be monitoring because this is something that could be very material in the many years to come. It's one of those things that's not going to disappear. But at the moment, as far as the announcement is concerned and based on our understanding, it's too early to call Alphabet to be the winners and Nvidia or the AI GPU are no longer the place to be.
Interesting. Just one final question on Nvidia and the outlook here. I was just wondering, when you think about what's next, do you think that there's an area perhaps that they're considering in terms of cloud services? Is this something that they could actually come up with something else going forward and be more of a competitor with other players already in this place? Space?
So one area that we're looking at is AI agents. So at the moment, there's certain the likes of Salesforce, they have some AI agents that is going to be a more sophisticated version of just a chatbot, right? Utilizing AI to help companies to automate some of the tasks or trying to tie that up with the end systems that you're utilizing. So there's a lot of interesting opportunity there that we are looking at. But I think one thing that investors need to be conscious of is we are at the beginning of this race.
Yeah.
And ultimately, if you think about Google search was the 7th search engine being created, which means that the other 6 have disappeared. And it's not just about the first mover advantage, right? Ultimately, you need to get something working. You need to be able to do it so well that no one is doing it, so that you take up all the market share that is possible. And at the moment, everyone is doing it. And of course, if you're just running a diverse portfolio of, let's say, with 100 companies, then you can probably just tiptoe into different companies, see which one worked out, probably what the VC would have been doing in this AI domain. But from our perspective, being a very high conviction, highly concentrated portfolio, that we need to have more confidence or more evidence. So we are doing some work on it, but ultimately you would expect that we are not going to have hundreds of AI applications, right? You would have something similar to your like Google search, that because someone is going to be very dominant. But at the moment, even though Google has won the race in search, but we are not clear whether they're going to win the race in the AI, Gemini, kind of the ChatGPT domain. So that's a question mark that investors will need to reassess.
Let's look a little bit at other narratives happening at the moment. When I was looking at the geographical spread of your portfolio, 76% is exposed to the United States. Please correct me if this figure has changed in the meantime. I'm just wondering, as we are discussing American exceptionalism going into the new year, is this a concern for you that perhaps there's too much exposure here to U.S. equities? Is this something that you're thinking perhaps of scaling back into 25?
So firstly, we don't like the U.S. stock market on a very high level, right? Because ultimately, out of the just about 25 companies that we invest into, we have about 15 companies that are American companies. And so when we talk about the US market, we are only thinking about Nvidia, Broadcom, Vertiv, Philip Morris, and some others, right? Like, so I'm not thinking about the stock market. I mean, I look at Walmart, which we haven't got a position in. I look at the share price of Walmart this year, it's gone up like 80%, and it's trading at over 40 times earnings. And I struggle to understand. I'm sure that there's a reason for it. So when I look at a lot of companies in the US, the valuation doesn't quite make sense. So I would share the narrative about the US market of quite expensive for what it is, maybe on a back of Trump, maybe on the back of how powerful they are, how wealthy the American consumers are, and then unlikely going to go into a recession like maybe Europe or the UK into next year. But there's a price to it. There's a price to it, right? So when I look at the valuation of the US market, I do not feel like that is actually undervalued. But if I look at the likes of Broadcom, yes, I do. I can see the drivers. I can see how they can make more money over time, and I can justify the valuation. So when I talk about the US market, it's that. But I think the one thing that we do know being quite clear, is the American consumers are very wealthy. They are in a very good position. And when you just look at the stock market, because every investor would have their home biases, like if you're based in the UK like we are, and then you got invested into the UK stock market, you probably feel less wealthier than if you have been exposed to the US stock market being American. So they are quite wealthy. And at the same time, I think as far as we can tell from Trump's initiative, that he's going to make it even better for American consumers. So it seems to us that there's a reason why there's a lot of capital being attracted to companies that are exposed to North America. And you can argue that, but to us, I think ultimately it's about the real numbers, because obviously Trump is not been in place yet. I mean, it might take him some time to get the tax cuts and all that stuff. And so that's going to be some question to be answered next year. But we can share the narrative why a lot of money has flown into America, but we don't see it that manner. And just to cover that angle, that we do have majority of the fund in North American companies, over 75%. But if I look at the end revenue exposure, it's only about 40%.
Got it.
So what it means is Nvidia for sure is an American company, Broadcom for sure, but it's actually not just selling to Americans, right? Like you're selling to European kind of users too. So it's only about 40% exposed to.
I would like to broaden out our conversation into other sectors. I was also quite interested to see within your portfolio, Sartorius, Moncler, and Nintendo. Let's start with Moncler. I would like to get your thoughts on the luxury space more broadly. Do you still own Moncler? And what did you make of the rumors that perhaps they could be buying Burberry?
So on a very high level, we probably got our timing wrong in terms of luxury brands. We do like luxury brand company, like it's part of our thesis that we like the business model, we like the kind of pricing power. So we used to have many more companies that are exposed to luxury. But at the moment, we continue to like Moncler just because it's a lot smaller brand. It's idiosyncratic. They're trying to de-seasonalize their offering to their followers. But of course, the elephant in the room is China. We are not sure about China. We are a bit cautious about China. And at the moment, obviously, all the luxury brands, including Moncler, is very much depending on Chinese high-end consumer spending, which then, if you follow what's going on in China, is not very optimistic in terms of whether they're going to die up their spending in luxury anytime soon. So we probably got our timing too early. But what I would say, though, is over time, given the valuation is being very attractive, at the same time that you might expect Indian consumers could come in at some point, given that Indian economy is doing quite well and they would want to go into some of the luxury space to spend their earnings. So we do like the long-term story. Okay, so going back to this Burberry situation, is we would probably prefer that it's not going to happen. And based on our observation and understanding, is maybe it's not going to happen, but you never know, right? So given a choice, we want to keep our investment thesis simple, like Moncler is what we like, and we want to keep it in that manner.
Let's see what they will do. I also want to look at healthcare. It is 12% of your portfolio exposure, and among your top 10 holdings, you have Sartorius. Explain the rationale behind owning so much of Sartorius here.
So from our perspective, like being a high conviction fund, and what we want to achieve for investors is to maximize your returns. Like we want to achieve the highest level of return possible, depending on what we have in the fund. And one way to do this is to invest into companies that are exposed to megatrends. Of course, we already spent a lot of time talking about AI. That would be one of the very typical example, right? Given that we have already gone through that. But within the healthcare domain, that we continue to like biologics space. So basically, people have followed the space, that COVID vaccine was on the back of biologics development. And we have both companies, Sartorius and Danaher. Danaher, I think may not be in the top 10 today, but we have both companies in the fund. We do like biologics, that we do expect that AI is going to accelerate drug development. And if you look at the drug development pipeline, that 2/3 of the drugs are being developed using biologics versus chemical or synthetic kind of formulas. So if you are making the mission critical equipments, a bit like your pick and shuffle play, similar to a semiconductor equipment company, so Sartorius and Danaher, they provide the equipments for biologics drugs to be manufactured, then we'll expect them to do quite well. But if you look at the performance of Sartorius or Danaher over the last 2 years, they have not done well. So they have been detractor in our fund, but we continue to like the thesis. So we want to keep up with our investment, which means that we are buying a bit more when the valuation are more attractive, when the shares are not doing well, into 2025 and 2026. And I think if you look at the underlying numbers, that we already have started to see signs that some of the spending are coming back, but in a very slow pace.
I also want to look at consumer discretionary. It's another big sector in the portfolio. What names do you like here, and are you picking up on any other mega trend in this space?
Consumer discretionary is a difficult one. I mean, we do have a Nintendo in the fund, that we have had the company for the last few years now. Obviously, if you follow the Nintendo space, they're going to launch the new Switch, which is quite exciting, I would say. And the reason it's exciting is we think when we look back on the success of the current console Switch, which they launched about 7 years ago, they are continue to be very popular. Like consumers are still buying the Switch as we speak today. And also, if you look at the expectations about how many people are going to buy the new Switch or upgrade to this new Switch is going to be launched next year, that number seems to us to be too low. So that's a bit of upside potential that the market is not expecting too much, and we think is actually quite promising. So Nintendo is one of those companies that we do like. I think in the context of on a very high level landscape about consumer discretionary companies, that we are a bit cautious in general, just because we have flagged this since 2022 and we still remain of the same view that consumer disposable income is going to remain under pressure for a long time. Maybe with the exception of American, because Trump is now in charge, maybe he's going to make it easier for the American consumers. But outside of America, I think we are we are under pressure, like energy prices. If you look at the interest rate remain to be very high, mortgage rate remain to be very high. And at the same time, we have the tax increases in the UK, for example, through different means. And consumer disposable income is being squeezed from all angles. Oh, actually, I got one for you. So we do like within the US market is the US sports gaming. So that's discretionary. And we have this company called Flutter, which is in our top 10, that they are the market leader with their flagship product called FanDuel, alongside DraftKings, who's a competitor, that they're exposed to the US sports gaming market. So obviously you follow the market in the US, which everyone would know here, that they only started legalizing sports gaming a few years ago. So what it means is if you look at the size of the US sports market, it's significantly bigger to the rest of the world. You look at the GDP per capita for American consumer, they're a lot wealthier than the rest of the world. And they are very similar in a way that they like their sports. They want to take part in the sports kind of gaming. And so then when you put all this together, this is considered to be discretionary spending.
Yeah.
And if you take these two companies together, it's a duopoly market. So these two companies control over 80% of the market share, right? About 50-50 each between themselves. But then if you look at the revenue between these two companies, it's about $10 billion. So $10 billion is after they pay out all the winnings. So this is the money that they're keeping as the revenue. But if you really think about it, this is where we like to invest into, is a few years ago, that number was zero. Now it's $10 billion. Of course, the projection will be a lot higher going forward. And then you think about like, where does this $10 billion come from? It's come from somewhere, right? It's come from American consumer maybe spending less money in Starbucks, Walmart, Amazon, holidays, or some other stuff. I don't know where the money is coming from, but that money has gone into Flutter and DraftKings in terms of sports gaming. So this is very idiosyncratic consumer discretionary, but I think on a very general level that we remain to be cautious. But if you can offer something that's very unique, that is great.
That is the one call. Before we conclude our conversation, Stephen, I just like to understand how would you describe the market environment for 2025? Because I know that you said for 2024 that things were very challenging. I just would like to understand how are you feeling about it going into the new year? And if we were to say that AI dominated your positioning in 2024, what would you highlight as the main theme for your position in 25?
On a very high level, with Trump coming into the office, not just in 2025, probably in the next 4 years, that the market is going to be more volatile. Volatile means that there's going to be a lot more headline risk. But then, of course, from an active manager perspective, is whether we need to work out whether it's going to be material, whether it's going to be real, right? Like that's the decision that we need to make. But there's going to be a lot more headline kind of Trump-related comments that might have a lot of implications on your investment portfolio. And secondly, of course, given what we have spoken about the Max 7, that we are increasingly negative, right? If I look at the index weight within the MSCI World Index, it's about 25% in Max 7. And if I look at what we have in Nvidia, Meta, and Microsoft, that we only have about 10%. So we are very much underweight the Max 7. And of course, this year has been quite easy. Anyone who have invested in the Max 7 would have done very well. You don't need to own the stocks that we have, but you would have done very well already. But I think next year is going to be a year, I would imagine, that if our view is correct, there's going to be more differentiation in return. Because if you're just buying a tracker, let's say S&P or NASDAQ or some other MSCI World tracker, you will be very much overweight or have a lot of exposure to the Max 7. And from an active manager perspective, which majority of maybe my peers has not done as well as us, that they have struggled because they don't own any of this Max 7. So I think going into next year, now we share some of the view that we are equally underweight, that could be more differentiation in terms of return. But you need to be right on that. So let's find out in 2025.
Let's find out. Not long now. We appreciate your time today. That was a great conversation. Stephen Yu, the CIO of Blue Whale Capital. And our subscribers, thank you as well for joining us today for another Pro Talk. Recording and full wrap-up will be available on CNBC Pro. The next CNBC Pro will take place in January. Check your email for that invite and enjoy the rest of the trading day.